Hello, I hope you're doing well. We're here for the fourth session of the price action course, and in this session, I want to talk about different time frames. This is a very important point for you to have a correct understanding of the price chart, have a logical analysis, and be able to trade based on that. For example, I want to tell you if you're going to take a trigger in the 15-minute time frame, or if your trading time frame is 15 minutes, does the weekly time frame trend need to be important to you or not? These are points that usually confuse many people in the field of analysis. For example, someone says, okay, I don't want to trade against the trend, but they don't know the correct definition of a trend. But in what time frame is the trend important for someone who wants to scout? In what time frame is the trend important for someone who wants to have, say, a medium-term trade? Now, in the style we're teaching you, we're considering 3 time frames in total that we need to examine. And we don't have any obligation in the lower time frame. Let's move forward and I'll explain it to you. First, let me give you a perspective on time frames. Suppose you're driving and you want to go from Tehran to Karaj. Maybe you're planning to visit someone or just want to enjoy the drive. So you get into your car, start the engine, and think about which route you should take to get there. Well, there are different ways from Tehran to Karaj. Different highways exist, or you can take the special road. You can go through Shahid Famida and other routes. Now, how do you know which route to choose? Meaning, where is the thing that helps you understand which highway you should take by default? The map you have, meaning usually to determine our main route, we look at the map from above. We don't look right in front of us to see which lane is less crowded now or which exit is less crowded now. If I'm supposed to look at every exit that my eyes see in detail right in front of me, if I only want to look at that and move, well, naturally I might feel like I shouldn't go towards Karaj, but go the other way, say to Damavan, right? Because I was looking for the least crowded route. Wherever I reached the intersection, I turned into the one that was less crowded. So as a result, I need to check the higher time frame to make the right decision in the current situation, meaning working with 3 time frames. Check the higher time frame to be able to identify which route overall is the more correct one, shorter and gets me to the destination faster, and then come to the lower time frame to examine which lane I should move in under current conditions and see what's ahead so I don't crash, okay? Meaning I get some data in the higher time frame and I get some data in the lower time frame that shows me more details. So higher time frames show a broader and more general view of the market. Okay? Like a map, like Waze, like for example, the Nishan app and things like that. But a lower time frame gives me the insight to, avoid crashing altogether. It gives me the insight to see, for example, which lane to drive in to reach my destination faster. Or if I'm going to take an exit ahead and I saw it on that higher time frame, saw it on the Shan, I'll pick the right lane now to exit easily. And that's the most tangible example I could give for it. So the higher time frame gives me the big picture of the market, which is where I define my playing field. Meaning it's where I identify the support and resistance levels we discussed in the previous session. Now, where do I go to look for the trend? I look for the trend in my trading time frame. I look for chart data and analyze my graph there. In the lower time frame, I'm looking for the details. So the higher the time frame, the broader the view. The lower the time frame, the more we've zoomed in on the map, gotten behind the wheel, and are now looking right in front of us. Let's examine a few time frames. In the style you're going to learn from me, though I don't really call it a style. I talked about it a lot in the first few sessions. I don't want to bore you with it anymore. In my personal trading model, the 4-hour, 15-minute, and 1-minute are the time frames I analyze. You could work with the 1-hour, 5-minute, or 1-minute, or you could use the daily 4-hour and 15-minute. If you have a more impatient personality, this really depends on your self-awareness. If you're more impatient and basically want trades to close sooner, want to know where you stand, and can't handle a trade stand open for a day or two, you're better off with the 1-hour, 5-minute, and 1-minute. If you'd like to, say, make 4 or 5 trades a week, and you have 2 or 3 hours a day to be at the charts, and you have time every few hours to check on an open trade, you can get into the 4-hour, 15-minute, 1-minute approach that we use ourselves. Meaning, in the course of, say, a week, I might sometimes do 3 or 4 trades, and other times, maybe at most 7 or 8 trades. If not, and you want, say, 1 trade a week or just 2 trades total, and you have a patient personality and can wait, looking for set and forget setups, then you'd go with the daily, 4-hour, and 15-minute time frames. Now, what do these mean for me? When I say 4-hour, the 4 becomes my higher time frame. I just memorized the name. The 4-hour is my higher time frame. The 15-minute is my trading time frame, and the 1-minute is my lower time frame. What do I do in the 4-hour? Meaning my higher time frame. In this time frame, I identified a support and resistance that we talked about in the previous session. In fact, the obstacles that stand in the way of the price and the time frame and my trading time frame, which is 15 minutes, are the same swing highs and swing lows of the 4-hour time frame, or the support and resistance levels of the 4-hour time frame. Let me say this, and then let's go to the chart so I can show you how it works in practice. In the trading time frame, we're looking for swing trading. Now, here we start trading. Our high becomes the 4-hour high, the 4-hour resistance. Our low is the 4-hour support, and we mark these levels. Now I have a playing field for myself. In this playing field, we'll learn about uptrends and downtrends in the next session. Trend identification, which is one of the most important points of our course and the point that many people struggle with. I mean, many of my own colleagues, when I see their posts, stories, and the data they give to users, I see that there's really a struggle in understanding the concept of trend. And if this issue is resolved, many of your problems will be fixed. Now here, I'm looking for the trend, looking for the reason for the price movement, looking for weakness and strength, which is our upcoming topic, so we can identify the weakness and strength of the trend when reaching a resistance or support area. In the lower time frame, I'm looking for more details. Meaning, if I want to get a trigger earlier in the entry zone I found in the 15-minute time frame, I'll look at it in the 1-minute with more detail. That is, one 15-minute candle is made up of 15 1-minute candles. So I can see these 15 candles. How do we go about shadow hunting in our channel? Meaning, we go and buy exactly at the bottom of the 15-minute shadow or short at the top of the 15-minute shadow, where the trend is changing. Because in the lower time frame, we see that form shadow with more detail. So taking a trigger in a lower time frame makes my stop loss smaller relative to my take profit. So in practice, I can say that the balance of details, the balance of supply and demand, and the entry and exit timing of our trade will be obtained in the lower time frame, which is the 1-minute. Now let's go to our chart. I have the Ethereum chart here. Let's go to another exchange. Bybit, for example. I'm in the 1-hour time frame now. The 4-hour time frame is the one where I should mark support and resistance. According to what we learned in the previous session, my support zone will be this area. This resistance zone. The last swing, high and low, are a higher priority for me. It would be this area. Now, should I come to this 4-hour chart and say, okay, I should short the high here and long the low? No. When the price enters the 4-hour high range on the 15-minute time frame, which is my trading time frame, I no longer look for a long trade here. Unless my high is broken, we'll go further and I'll explain about the trend and you'll understand this. Meaning, when I'm at the 4-hour low on the 15-minute time frame, I look for the trend. Where the trend becomes bullish, I look for its pullbacks to go long. Now, we have 5 different types of trading setups that we'll learn in the last session. So for now, we're learning how to analyze. Next session, we'll learn about the trend. The session after that, we'll learn candle by candle analysis. We'll learn about weakness and strength. And finally, we'll learn how to trade. Meaning, until the second to last session, I'll turn you into a good analyst. And finally, I'll teach you how to trade, because they're 2 completely different subjects. Well, now I'll go to the 15-minute chart. For example, these are important to me. If I were to consider every swing high I see, then this is also resistance, and this is also resistance. Nah, guys, these no longer matter to me. meaning I don't need to mark these. These will be places where, after I've taught you and you've entered a trade, there'll be places where we look to take profits or look for an entry point. So in practice, my plan field becomes this range. Okay, these two lows and highs. Now, if I go above this level and break this high, I'll look for my new playing field on the 4-hour time frame. If I break this high, for now, the last price high that Ethereum hit is important to me, meaning my new playing field becomes this area. I can look for long positions here again up to the $4,100 high, and again at the $4,100 high, I'll go to my trading time frame, check the trend, check the strength and weakness to see if I should short this high or hold off because it might be broken. Let's also take a look at the 1-minute time frame. Now, suppose I don't see any signs of weakness for now, meaning I see the price pause, but I don't see any signs of weakness in the uptrend, and I don't see any strength in the downward direction yet either. You'll learn this later on. I'll go to my 1-minute time frame. If I were to short here, see how much more detail I have now seeing my area on the 1-minute time frame. What happens if I go to the 15-minute chart? These two 15-minute candles with 5 minutes left on the last one give me 25 1-minute candles. Look, from here to here, there are 25 1-minute candles. If I spot weakness in the 15-minute uptrend, I can then trade the 1-minute trend reversal. Once you learn how trends work, you'll understand. I look for the peak in the 15-minute time frame. If I see signs of the uptrend weakening, I'll enter a short position, but I don't see that yet. If I see a trend reversal and a pullback on the 1-minute chart, I'll enter with more confidence. Since my main trading time frame is 15 minutes, my take profit and stop loss levels are set based on that. So if this support level breaks, my final take profit target could be all the way down here. Consequently, I won't have a very wide stop loss on this trade. I can switch to the 1-minute time frame, clearly see the trend reversal, and find a great entry trigger while keeping my stop loss small relative to my target. You shouldn't worry about the size of someone else's stop loss. If someone has a 30% stop, what does that matter to you? Maybe, just maybe, their take profit target's 80 or 90%. It's not like a trader must have a 0.5% stop loss to be considered a professional. That's not how it works, guys. The volatility range varies significantly between different cryptocurrencies, and everyone's trading time frame is different as well. So depending on your time frame, the risk to reward ratio is what matters, not the raw percentage of profit or loss. Regardless of the percentages, you should manage your risk by adjusting your position size so that each trade carries a consistent level of risk. Okay, so if a spot trade has a 10% stop and a 30% target without leverage, I might use 5 times leverage. That makes the stop 50% and the profit, how much? 30% times 5 is 150%, right? Now, if that same trade had a 1% stop and a 3% target, I might use 30 times or 20 times leverage instead. It depends on how much I'm willing to risk per trade, specifically the dollar amount I'm okay with losing, which is determined by my total capital. If I have $10,000, I might risk $20 or $200 per trade. If I only have $1,000, I'd risk $20 per trade. These amounts vary. Support and resistance levels on higher time frames, which I've already explained to you on the chart, are considered the primary levels where price action typically slows down or stalls. So if I'm trading the 15-minute chart, the 4-hour support and resistance levels are where I'd expect the price to either pause before breaking through or reverse entirely. The support and resistance we have in the trading time frame are swing highs and lows, meaning the swing highs and lows we see in the 4-hour chart become our support and resistance levels. Based on those, as I said, we analyze our stop losses, take profits, entry points, and things like that. We see signs of support and resistance in the higher time frame and in the trading time frame as well. But the swing highs and lows in the trading time frame aren't important in the higher time frame. Let's go to the chart and see this. Maybe it's a bit hard to understand. Look, these are my swing highs and lows. this isn't important to me at all in the 4-hour time frame. This isn't important to me in the 4-hour now that I'm in the 4-hour, okay? My important 4-hour levels are these lows and highs that caused the trend change. Here, the price was going up, hit this point and dropped. Here from the bottom, okay? In the previous session, I told you which highs and lows are more important. Highs and lows are more important where the price was quickly rejected from that level. So in the 4-hour time frame, this is no longer my low. This is my high. This is my high. As soon as it hit, it got rejected, showing that in that area, the battle between buyers and sellers reached its peak, and sellers were able to overcome the buyers. But what's here? A trend has formed and moved. Each of these highs and lows is no longer important for the 4-hour. But when I go to the 15-minute time frame, look, these themselves are acting as support and resistance. So if my trading time frame was 1 minute, I would come here and draw the 15-minute highs and lows. This will be my playground for trading in the 1-minute time frame. But now that I'm trading the 15-minute, this high and low where I've drawn the zone is important to me. Now, it's true that where it was rejected in the 4 hours still seems like an important level to me in the 15 minutes. But where it was rejected in the 15-minute might not even be noticeable in the 4-hour. Why? Because it's showing me more details. Price moves within a structured framework of support and resistance. It's not set in stone, but it's the definition. Based on the definition, we have this mindset. Price always moves within a framework. I said, for example, it breaks the previous high in the 4-hour and goes into a new range. In my opinion, it's going to range here. Then go one step higher and break the resistance. Between this resistance that was broken and become support up to the next resistance, the price can move. For me, the playground is like this. Breaking the structured framework of support or resistance leads the price movement in the next framework range. Just like what I explained to you. Look, here. Now, for me, imagine I'm analyzing from here. I have a low here and a high here. I expect the price to move here. Where this floor breaks, okay. Where do I go? I come to see this. I say, okay, I've lost this floor. Now, it'll be between this ceiling, which was a floor before, when it breaks, as we've explained. Support that breaks turns into resistance. Now, when this breaks, I expect the price to move between this resistance and this support. And that's exactly what happens. When it goes back up again, I expect the price to move up to this resistance, where I've already marked it. And that's what happens. Where it returns, see, the price is moving within this framework. Believe me, I didn't predetermine this. Any chart you bring, I'll draw it for you like this, because it's not hard. Analyzing is a simple task. Now this support breaks, right? My support broke it there. I expect to go to the next range now. Look. Right? It comes and plays in this area. Let's go somewhere else entirely. Look at this. The price is moving in this area. I've already said how I draw these support and resistance levels for the swing highs and lows. When this resistance breaks, I expect it to create a new player field for me. Well, because in this time frame, I can't see the past. I don't have the data. Let me go to a higher time frame. Let's see, it was around here. The area that's important to me is this range. Okay, I expect that when this floor breaks, it will play in this area. And it's not set in stone that this would definitely happen. You see, this framework should be for you and any time frame that is your higher time frame. Now, I've told you about 3 types of it. For example, in the 4-hour, these highs and lows, these areas should be clear to you. If a ceiling breaks, you expect how far the price will move after that. Your expectation is important when you're analyzing. We're not going to say with certainty that it would definitely go to the next ceiling or not, but we'll work based on the definition for now, until we add our own data with more detail, considering what we see from the trend's weakness and strength. Until you know a series of definitions and basic data, you can't make any changes yourself. You can't build a strategy for yourself either. Market structure is support and resistance, and it's enough to draw it in the 4-hour time frame, and my structure will come out in the 15-minute time frame. Well, what mindset should we draw? If we draw support and resistance based on every peak and trough of the fluctuations, the chart will be full of lines and zones. I mean, if I were to draw every peak and trough I see, I'd have a ton of lines, and it would look messy, like the charts of some people you see who are beginners or losing traders or scammers, showing you, wow, look how many lines his chart has. Look at all these pretty things he's drawn. Whereas we basically just check 2 4-hour lines for the trend's peak and trough. We visualize the future trend in our minds or mark it on our chart, and we try to keep predicting until we get the hang of the chart we're working on. Because guys, some things are actually different across various currencies in the crypto market. For example, if you're working on Bit, you need to get the hang of certain things. When you go and work on Ethereum, you see that some minor things are different. And if you focus on, say, 5 or 10 different currencies, it could be better. If you're trading purely from a technical and price action perspective, now the strategy we use ourselves is the Bigalar strategy, because we choose our chart and our target currency based on fundamental data. And since we know this currency has money flowing in, it doesn't matter to us how much we know about it. We enter the trade within the zone that our strategy gives us. But the prerequisite for the Bigalar strategy is this very data you're getting in this course. If you don't notice, that strategy won't be of any use to you. Even if you pay to learn it, you won't be able to use it. We only focus on the zones and levels that have more importance and seem relevant. What does that mean? It means they involve more touches. Besides that though, I didn't write it here, they've caused the trend change in our trading time frame, meaning the peaks and troughs that cause the trend change. We've seen the highest amount of supply and demand imbalance in that zone. The price was rejected with long shadows or rejected with strange engulfing patterns. Those areas become my important supply and demand zones. Based on the definition we learned, which are the most important support and resistance? Where the price is quickly rejected. I keep telling you everything in advance. I've taught this so much that I'm subconsciously telling you the next slide. I'm spoiling the next slide for you. Where the price passes through quickly, meaning where the urgency of buyers and sellers has the greatest difference and the most supply and demand imbalance is seen. Based on our thinking, what should our thinking be from the first session? Instead of looking to draw lies, I should always think, if I want to say which support is important, instead of saying it has more touches, I should say, hey, from here, the buyer's strength outweighed the seller's. What was the decision of the buyer and seller in this area? Why is the price sometimes gone below support, made a shadow, and then moved upwards? I should be able to understand this based on the decision of buyers and sellers, so that as we move forward, well, once the course is over, I'll start trading with you. So my goal is to start sharing my own personal trades on the YouTube channel after this course is over. So whenever I'm about to enter a trade, I share my entry points with you. Then in the next video, I'll share the results and give you new entry points for the following week. Basically, I'll be sharing the trades I make myself with you every single week. Well, I hope you found this video helpful. If so, you can support us with your valuable likes and comments. I hope you don't discourage me from continuing this course, because people usually don't value things that are free. However, this course will make you independent of all those paid courses that charge you money to teach this same data much less effectively under different names, using complex terminology, and forcing you to memorize strange patterns. It truly covers everything you need. Trade safely and be successful.